Well, students, after a long time, it was merely a gap, and I went for vacations and then came back after vacations, spending 2 months or 3 months. So, therefore, I'm just again doing bit revision and making you guys understand the concept of starting from the capital asset pricing model. In the capital asset pricing model, I'm not discussing the entire model because I have already discussed it, that in the capital asset pricing model, the concept of beta, okay, which is a factor of the systematic risk, and measure the sensitivity of a particular stock related to the entire market. This is a bit different from the sigma, which is known as the standard deviation. So this is a part of the revision, but here a new concept I am driving here, and driving from the same model which is known as the capital asset pricing model, in which the concept of the alpha. What is the alpha? Actually, alpha is one factor which is used to determine the realized return of the portfolio and how much it varies from the required return or the expected return. For an example, I am just writing here the formula of the expected return of a X stock. So you know it very well that this is a spread of RF, which is a risk-free rate, okay, and plus beta and the premium. A premium is calculated the difference between the market risk and the risk-free rate. This is a risk premium, okay. This is called as the risk premium. We have already discussed it in our previous videos. Now we are about to calculate the alpha. So how the alpha will be calculated? First of all, alpha, as I told you, that it is used to determine that how much the realized return of the portfolio varies from the required return. So just take a look here. This is what the formula of is known as the Rx minus expected return. Rx is a realized return, this is a realized return, and this is the expected return. So if we put like this, so it will be taking a shape like that, minus, just put it in the bracket, RF, beta is a systematic risk factor, and RM minus RF. Okay, so alpha. If for an example alpha is found, there is a possibility it may be positive, okay, this may be negative, and this may be zero as well. If there is found positive, that means you must buy the stock. If it is found to be negative, then you must sell the stock, and if it is found zero, for an example, so it is suggested to hold that particular stock.